Welcome Travis Jack, who's a CPA, QKA, who's the managing member at Met's CPA. And hey, Christopher, I really like the fact that he's a QKA.
I know you do.
Yeah.
And welcome to the 401 Couple podcast, Travis. Okay.
Love it.
Very happy to see you. And so instead of like reading bios and things like that, we suggest that people go and find you on LinkedIn, and you are very findable on LinkedIn. Oh, and I hope you have your treat. Is it there by the mouse there? Okay. So there's more of us, so we have more. So now then, those of you who watch the YouTubes, you know that our shtick is that Catherine and I drink bourbon, but the podcast has to be different shirt, different everything else. And here, the guest picks the treat, and we've had people wanting to eat their feelings and drink their feelings. And Travis is referencing his hometown roots, where he's from, the great city of Green Bay, Wisconsin. So, of course, we have Wisconsin cheddar. And because
Christopher was more excited about this than bourbon. He was really excited he was going to get cheese.
Yeah, cheese and crackers. But then, the cheese is from Wisconsin, and the curds are from Wisconsin. They're cheddar curds from Wisconsin. So please don't give me any crap about them not being freshly deep fried and all that. Okay, this is not that sophisticated a podcast where we got a deep fryer behind the camera.
What we're actually here to talk about today is retirement plan audits, which are commonly known as large plan audits. So let's talk about when you're approaching the plan size, you need a plan audit. It is certainly a size that a plan gets to. Then they need someone such as you.
But is it assets or head count?
Travis.
Great question. And recently that's changed quite a bit too, because it's always historically been eligible. And that's just changed in the last couple of filing seasons, which I think is a nice move. It actually brought the overall audited population that was cresting to about 89,000 down to about 60,000, which on the face of it as an auditor, you'd think that wasn't ideal, the client base shrinking. But I think a lot of the changes from the audit quality study, AICPA enforcement efforts on both the peer review side and EBSA's enforcement efforts in the audit quality study with some kind of so-so results have really moved the needle from about 10,000 auditors at peak about 15 years ago to we're down past 4,000. So the number of individuals providing service in the market for that particular space is also reducing. The year before they changed the participant count methodology, I think it was really challenging for your average plan sponsor to find an auditor at a good quality and reasonable price for the most part, especially ones like you were talking about that are just getting over that audit threshold and maybe not finding out right away, or maybe they miss a standardized email from a service provider, and they're kind of caught off guard in July, sometimes August, things along those natures. So yeah, definitely I think was a pretty big impact moving from eligible to individuals with actual account balances. And it kind of eliminated that component of sometimes you'd be doing audits for people with 20 people in the plan. Which I don't think is...
It's got to be great to have a client. You're going to give them a $20,000 bill. They've got 16 people in the plan, despite the fact they have 700 plus employees. That's been real life situations for me. So that was, now then, why the change? I know you know the answer.
In terms of the...
why did we go from eligible to head count? I mean, to actually having an account balance.
Oh, yeah, 2 years ago. So
the why is because of long-term part-time employees.
Yeah.
Yes, because that would have been a massive show. And because you're going to have all these long-term part-time employees are now going to be considered eligible, but most of them are probably not going to have an account balance. And I think if employers who thought they were a small employer started having to pay audits for 20 people with an account balance and 140 people supposedly in the plan, they were not going to be happy.
Is the first plan audit year for that going to be 2025 then?
24. 21, 22, 23.
With participant bill. Yeah.
It's account balance is 2024. This is the first year you're doing it that way. Right.
Yeah, 3 and 4. So the last filing season,
three was
we're always doing the audit the year after. So yeah, we already have one under the belt, and then coming up on that. The one kind of odd nuance as well too is this goes against everything that's typically been for first year engagements. With moving to participant balance, since 74, it was always beginning of year determination, which is still the case for ongoing. But when people are hopping over in that first year, everyone would get a pass on the audit. So it's buried in the Federal Register, and I don't think it was readily available, but it's ending balance for first year, which kind of caught everyone off guard, including a lot of CPA firms as well.
Okay.
Even
So what about with technical, very detailed question then? Okay. So what about, is it cash basis or accrual for the head count? Seriously, it could be a vastly different number. Which one? Because my understanding, the 5,500 instructions do not say.
Mm-hmm. We typically follow the reporting methodology on the 5,500. And typically what we've seen is cash basis for the most part. We don't have a gigantic sample base, but for the most part, I think people are headed towards, if they cannot have an audit, not having an audit for the most part. And a good portion of providers, depending on kind of the plan structure, we get 5,500s on more or less modified cash basis. So that we haven't experienced that too, where there's kind of that, if that profit share hit and it was accrued back, it would bring the participant count over. Most have been like PEPs, that it's inherently way over, based on ending balances for the most part. But
do you realize we could spend 50 minutes talking about just participant account, just counting the number of participants? I think we might that maybe needs to be a podcast. We're going to lose absolutely everybody. Everybody's already asleep. I think we're not doing live. The live stream just ended. Okay, so what else do you have there, Catherine?
Well, the first time that I heard you talk about this, you did talk about what the key thing is, maybe the highest indicator of quality audit person, meaning, I'd say, first-time buyers are looking for, like, what am I really supposed to look for in an auditing firm? And
how do you judge value?
How do you judge value? And you had a very specific finding in that study.
Yeah, absolutely. So it's based off the last two DOL audit quality studies were both statistical samplings. Those were the first 2 times that they had done it, and they're a good 6-7 years apart. Ironically, the deficiencies, unfortunately, were pretty staggering, which has kind of created a bit of a mass exodus out of the market over that period of time, reducing kind of the number of plan auditors overall doing that type of work. Because the ones that were doing...
So Travis, so the people we've been dealing with for the past 20 some odd years has not changed, who have been doing large plan audits. So based on what you're saying, that's an indication that the partners we're working with are very likely reasonable or respectable, or whatever the right phrase is.
100%. Yeah. Okay. Mostly it was firms that were doing 1 or 2 that had 76% deficiency ratios. The first study back 2011 filing season, and the one that came out more recently was 70% in that particular strata. So back to your original question, that's kind of the number one indicator of audit quality. So if you ask someone, or correlatable factor, I should say, that really kind of give you a good idea if someone's doing 1 or 2, ask a lot of questions. If someone's at 100 or more, makes sense to kind of go through the full RFP process. But that's kind of the cutoff where there's not much incremental difference between 100 and above.
So why? So the question is why? Why can't you have a good two plan Tony on the audit side? Why that seems to be statistically impossible?
Great question. And I think it mirrors a lot of what you'd see in the advisor community as well, too. When someone's doing a small segment of something and it's just a small part of their practice, they're generally not investing time into understanding some of the nuances of qualified plans, how they differ from regular audit engagements. It's kind of the biggest item for the most part, kind of just a lack of general understanding for that particular engagement type.
Yeah, it still maybe just blows my mind to think 70, a result in the 70%, because when I interview people to work for us, I always ask them, so how many acceptable mistakes would you find on a tax form?
So Kyle, how long do you think you'd still stay here if 76% of your distributions were completely inaccurate?
It is.
Hi.
As an industry standard, people just 3/4 is not good enough.
No,
you know what I mean?
That's bad for baseball. I mean, come on.
100%, definitely bad for business.
Yeah, definitely. Well, you have something about a case of an unlicensed auditor. I'd love to hear that one.
Yes. I always like to segue that one in. We had sent over
yesterday, and I'm like, no, surprise me on the podcast. So,
100%. So we did have an instance where we came across when you obtain a new client, you typically review the prior year work papers of the last firm if it was audited previously. So that's what led us into this deep dive that ended up with a number of phone calls with DOL's criminal investigation arm as well, too, that was also looking for the same auditor that we were looking for, which is kind of interesting. Turns out had been a combination, had been doing some TPA work as well as had a audit CPA wing, had become a felon, unbeknownst to some folks in the community, came out of prison and picked up where he left off, even though he was no longer a licensed CPA. There were financial advisors referring him into clients. So can you imagine that feeling? Like, I've just referred a felon into, someone's very, very intimate financial details and a treasure trove of PII. So eventually they did catch up with him, but this was in Arizona and Nevada.
I think I know who it is.
Yeah. And it used to be, it's about 21, 22 engagements that they were performing for pretty big, even including, some larger clients as well.
Okay. So, but what was the quality of the work?
Subpar.
Okay.
Definitely. I think if he doesn't have a license, he's not super worried on the quality side of things.
It might have been the absolute best audit you ever got. Okay.
Christopher's actually not just saying something silly. It's just we did a couple of acquisitions at one point, and we did find out that one did do some fraud. And
didn't pan out.
But the funny thing was the quality of that person's work was better than some of the quality of the work in the not
when she did the work.
When she
did the work, it was good work. Okay, the problem was doing the work.
Well,
but anyway,
and where the deposit.
Well, yeah,
the deposit.
Different podcast.
Right.
Different
podcast.
Yeah.
Horror stories. Yeah,
that's the episode 2 of internal control environment. From what to ask at the plan sponsor level.
And that leads into the question of actually, what's the advantage of having a different firm, your TPA, and then your auditor? I mean, that's walking straight into that.
Yeah,
Want that second set of eyes.
Very old school opinions on this. Let's talk about you, Travis. What you think?
100%. Yeah, couldn't agree with you more. I think there's a little bit of crossover. Also, you see it in some larger firms where they're developing or have advisory wings as well, too. Generally, I think what's come out of that has been, even though oftentimes they're separate legal entities, it gets really great from an independent standard. So a lot of times you see those firms making more aggressive recommendations on, we see it a little bit more on the advisory side versus having a TPA arm. But what happens too is it really kind of calls into question the validity of those comments to governance, things along those lines. I mean, I definitely, from an independent standard and kind of professional standards, really best practices to have those separate. And it gets gray to have them together, very gray.
So there are firms in the Midwest that have business taxes, your Schedule C's, Schedule K, and all that other stuff. They also have a large plan audit wing, and they have a wealth management financial advisor wing. Okay. And I know some of those firms for 401k plans or DB plans or whatever are trying to have all three sides covered. They're not the TPA. And I'm like, no.
Right. So we do know there's one in based out of Tucson as well too. They're an ASPA member, and they're originally kind of birthed out of a CPA firm, but they did divide the equity structure, and they actually don't cross refer on large plans, primarily due to that, and it kind of hamstrings them a little bit on developing CPA relationships outside of that firm, because I think people call into question kind of that independence and, hey, if I invite you to Thanksgiving, are you going to leave with the turkey kind of feel to it? But yeah, so that I think happens, and perception and reality, both.
Right. And I mean, you really have an audit to really make sure things are going well.
So what is okay?
Versus just covering things up. So
do you have? I'm guessing there's no numbers. How many plans, existing plans, have their first large plan audit for the following year on an annual basis? I mean, is there always like 2,000 or 3,000 401k plans going, surprise, you've got a large plan audit now? Or is it a bigger number than that or a smaller number than that?
I think it's about that, might be a touch larger. We're pretty good on the full population, but there's a little bit of churn. So some are dropping off, some are adding on. So definitely could get that stat for you. I think you kind of nailed it on the head, though, in terms of where I would arrive at from a kind of a net gain, typically in that population of plan audits becoming eligible. And a lot of times that is kind of a big area of, a lot of times they don't find out right away. Some are amazing. It depends on the service provider. Like we'll get calls in fall like, hey, we're going to be over going forward, which is amazing. And then we'll get calls from other service providers or other folks for a variety of reasons, like end of August.
It's the morning of October 14th. That's plenty of time.
Yeah, that's some October 3rd. We have a pretty quick turn time, but yeah, we've even had calls like a day or two before.
So all right, so when somebody's in planning mode and they've got some idea this is coming, okay, other than making sure you've done all your force outs, all right?
Yeah.
What should, other than looking you up on LinkedIn, okay, what should a plan sponsor do to get themselves ready to engage a large plan auditor? Never mind do the audit. What should they be doing at the beginning?
Absolutely. Great question. I would say probably, first and foremost, research in terms of kind of that RFP information. I'd say, even though, we'd love to be the only game in town, I think it does make sense to chat with 2 or 3 folks from a plan sponsor perspective. Because a lot of times it might be more of a personality feel, those kind of things, in addition to getting a feel for kind of processes, team assignments, things along those lines.
Yeah. I was just going to say, and then after COVID, it's no longer such a regional thing. Okay. I mean, I'm presuming you're taking large plan audit assignments. You're never going to meet the person and they're in Georgia or Maine or something like that, right?
Yeah, so that's become much more of a thing post-COVID. We used to spend a lot of time traveling, definitely still open to it. But a lot of times we do a lot of tech companies and some other that are like, hey, you can go to the office, but we're gonna get on a Zoom from our house. I'm not fighting traffic in San Fran Metro to come see you in person. So people are getting back to it a little bit more, especially once you get off the coast, depending on how big the city is and what traffic looks like. But yeah, so it is kind of interesting. I would say we much less than historically. We always offer, but a lot of times people are pretty agnostic. They're like, just efficient's great, and kind of want to wrap the process as quickly as possible.
So the thing is, one of the things and I know this can be a touchy subject, but one of the things that both of those surveys, testing, audits, whatever you want to call them, showed was that there was no correlation between quality and price.
100%. Yeah, that is nailed it. And that is actually, they came out and kind of reaffirmed that at the conferences with AICPA. Because it really is, you have some that are doing a handful that are charging, 2x, 3x national average with not great quality. And then you do have, you associate, I like to tell people, if you're kind of in the 8s, 9s, questionable, but still possible. Once you get into the 7s and the 5s, typically that's really probably a sole proprietor if it's still a decent quality, but a lot more questions, ideally below that. And that's kind of where they came across at the conference too. Huge range. Once you drop below a certain point, it's just challenging to perform the work in the amount of time based on, kind of those budgets and realization. So huge window though, and it really doesn't correlate statistically.
Yeah. And that's probably another good reason to maybe get 3 of them and maybe one of them from a different geographic area. And maybe maybe it's like Olympic scoring, throw out the high and the low.
Yes. Yeah, 100%.
Right? So,
or ask more questions on the low too, and especially if they're in range,
getting, right?
Yeah. 100%.
Well, okay. So for people who are looking at the first year of having, a plan audit, what should they expect? How do you lay it out for what the year's going to look like for them?
Business closes down completely for 6 weeks. Everybody's unemployed. Is that what we're talking about here? No, is it?
Right, no, yeah. No, ideally, probably engaging early. So, in an ideal world, doing the RFP process and fall, or as soon as when that's going to be a thing. The other one that's not necessarily indicative of quality, but I think is process organization and project planning, is what percentage of audits are you issuing before the January 31st deadline? I think that speaks volumes to if auditors are, planning and organized. Do they have a designated team that's just doing this type of work that's getting started January or even
getting
fall?
audits done in 31 days when we're lucky to get the data to start like the 10th or the 15th?
Yeah. So a lot of times what we'll do is we'll get set up for pulling ad hoc reports in the census, like January 1, and then ideally the payroll shortly thereafter and the census as soon as it's available. So that allows us to get all our samples selected, back to the service providers, back to the client. We actually have around 65% of our samples complete already, and it's, kind of the top end of March. So we really push and have a dedicated team that they just start pulling those and ripping through that process, day one, as soon as the holidays are over and the new year starts.
Dude, it's tensions, man. Come on.
Well, no, but
well, people will naturally find their way into those extensions. So we do have a huge segment that it doesn't matter how many times you beg, ask, they're probably giving you the census in September. So we're not getting it before then. But we can do a little bit to bridge the gap, and really kind of get payroll access and start pulling those things, making it a streamlined process for the plan admin. And usually they're short on time too. And they're, especially in that first year, they're going from a couple page filing that, they're like, hey, it looks good, let's send it off, to this much more elongated process. So anything we do to remove friction points and make it easy for them, we definitely try to do that.
already the way you answer that already shows something different than, I mean, our common feeling is that, the auditors don't like wake up and become conscious until like the end of second quarter, when they've finished all their tax work on the front end.
Yeah.
And that auditors are always, starting to look for reports in the summer. And this is already, you're jumping in January and getting a good shape.
What you're describing is a firm where the business tax, the 1120s, is completely separate from the large plan audit. So your associates are doing the large plan audits. They don't have any W-2s to worry about. They're just, on the business side, they're only doing large plan audits. So that's another example that you're going to want. That's something else you're going to want to ask for with your RFP information, is how segmented the business is.
Yes. Yeah, absolutely. 100%. Gonna agree with you more.
So I think we've kind of answered it, but also already the client usually will say things like, this is a hassle. Why do I have to do it? And we want to say, because. But what would you say to a client who says, this is
honestly, my root answer is it's really not too far than that. Regulation requires it as kind of that big baseline. With that being said, these particular engagement types, we do find issues, vesting, auto enroll, helping with corrections and kind of pulling everything together and project managing that after we've found it. We've also even found some pretty big crediting issues with a large audited DB. So there was a class of folks that were, kind of missing what the crediting rate that should have been applied for about 5 years. It kind of was a very significant impact, obviously, for those individuals. So I will say not every audit is like that by any means. And then I think when you get to other engagement types, like we found $1.2 million fraud at an HOA, I think there definitely is a reason to engage, independent CPA, and it isn't necessarily for, just for show in a PDF. A lot of times there is, and it's not every engagement, but a lot of times you can help internal processes, strengthen those. But with that being said, it's probably somewhere in between. I think people could get on the soapbox and be like, here's why they're amazing. I'm like at a midpoint. I'm like, there's a time and a place they're required. And because they are, I think we work to add value where we can. But if a plan sponsor's just incredibly organized, high level of detail, they've got a great service provider such as yourself, our impact's more to not make an impact on that. It's really that sweet spot. That's the best thing you can deliver, is like made it smooth, made it easy.
So then, because of what you just said, I'm going to segue to my first question that I think is a softball for you. All right. Because of what you just said. So we did an acquisition a number of years back, and there were a number of plans needing a large plan audit, old rules. Okay. And quite a number of the large plan audits all had the same firm. And we were very dismayed that the auditors had never pointed out multiple ongoing compliance failure to follow the document.
Okay.
They were doing things that were possibly legal, but in direct contravention of what the plan document said from day one. It wasn't a mistake at a mandatory amendment restatement. You go back to the original document, you look at the provisions there, it says X, and they've been doing Y the whole time in all these plans, and it was the same auditor the whole time. So we as TPAs expect y'all to catch that stuff, right?
Yes, 100%.
It's reasonable for us to expect you to look at that.
100%. And I think there's elements, especially too, because the financials do have the first couple notes are kind of a regurgitation or summary of plan document elements. So definitely something should be aware of. With that being said, we do sample. It's not the full population that gets analyzed. So there is the potential, but year over year, one would think that depending on what the failure is, and some things are a little bit harder to catch than others. But yeah, if it's straight vesting or kind of those slam dunks. If you didn't mind, what were the kind of some of the main?
The ones that we remember very specifically is how employee direction of assets, all the owners were having all the Highleys for all these plans were having more options than all the rank and file, and the way the documents were written didn't allow for it. That's the generic safe on a podcast answer.
Yes.
And it was systemic
for out there.
all of them, and it wasn't a spot checking issue. It was all the Highleys on all these plans we're doing. And
that one kind of is mid range in terms of procedures designed around that. There are good portion of the participant data testing that does get into participant elections and changes as well too, and there's some testing and processes around that. So that is probably something that would have come up, but it's not necessarily as prevalent of some of the other errors are truly like demonstrate a lack of plan understanding, period, where that one's kind of somewhere in the middle where it probably would be picked up, but a little bit more obscure than some of the issues that we see on a day-to-day.
Pivoting from that, do you do maybe, is there any review of who the employer is in your thing, in the scope of your work? Like, is it a control group? Is it an affiliated service group? Is it actually a closed map and they've been lying to us? Speaking for
yes. So there definitely is during onboarding some review of entity structure, discussion around that. And then kind of when things come in, because there are a lot of times where might be multiple LLCs, multiple payrolls, which is a big consideration. And having those laid out on the front end is super important as well too. So there's definitely some scoping on the front end that kind of encapsulates entity structures, ownership structures, things along those lines. Because it's really key for determining party and interest transactions, parties and interest, et cetera, which is a huge hot topic, DOL, and just in general on the audit side.
Yeah. So word of advice, if I may tell you how to do your job, do that every year.
Yeah.
And I learned it, and I learned a new phrase a couple of weeks ago. No Sally. Same as last year. Sally's not allowed. We hate it when somebody answers that. Yeah, because it's 100%. Always wrong. Every time somebody says same as last year, no, it wasn't.
Yeah, we do ask if there's been any changes. So kind of a little bit different, kind of deep dive. And a lot of times too, there's a lot of conversations in the planning side where that comes up. Changes in plan documents, entity structure, ownership structure. Anything, a couple lines of questioning that get towards if there's been a partial plan termination, things along those lines that would shift some of our procedures a little bit.
We do have that part of our ongoing process, but that can still surprise people. Look, he's got an Oktoberfest water mug there. Goodness gracious! All right, I do have an. Are you done with questions, Catherine? I can't remember.
I mostly am, though. Other than how many times do you actually have like a Department of Labor or an IRS audit on an audited plan, on a large plan audit? Is the percentage of that a lot lower because you have the oversight that you guys are doing, or?
A little bit. So it's kind of a nuance, and we actually have had work paper reviews, which have gone excellent. And our last one was part of the previous audit quality study. So all went great. Got basically no changes. Keep up the good work letters, which was always fantastic. Should just pop that at the end of the proposal or RFP, but But yeah, so, and we actually work quite a bit with EPSA DOL, absolutely great folks. Very, very nice, as part of AICPA's conference planning committee. They're always invited each year, and they participate both in kind of the planning, excellent working relationship overall. And I think a lot of the folks on the committee would mirror that plus. And they're great. They're super easy to work with. Ironically, great senses of humor as well too. Fantastic folks. But it's nice because a lot of times you can run by compliance issues or things that pop up in terms of documentation of termination dates. Like, is it a 1/1, a 12/31? Kind of syncing some of those things up, kind of oddball circumstances that show up from time to time. Or two, they put us in touch with, the folks and head of the 5500 filing and compliance updates regarding GOPS when we were doing an article for kind of how the audit requirement will apply to group of plans.
Oh, group of plans. Okay. Haven't had any of those yet. So.
Yeah, and I'm curious how that goes. It just seems like it retains quite a bit of extra legwork compared to a PEP. So feels like it might not get the same amount of steam depending on the situation.
I can't see the business upside for a group of plans, but it doesn't seem to make much difference. But anyways,
I'm good.
You're good. Okay. So now then.
So now,
now I got mine. Okay. Asking for a friend. So this used to happen to me all the time. Okay. Now, I've been doing this for a long time, and it has been a number of years since, according to the staff, I've actually done any work, because they kind of all got together and decided it would be much better if I didn't do anything for real for plans. So if this doesn't happen anymore, don't take offense. Okay.
100%.
But when I started doing this in 1990, it was very clear that the TPAs were the dumping training ground for brand new CPAs on large plan audits. Okay. No, seriously, we had to explain to them what ERISA was, what a deferral limit was. We had to explain the difference between eligibility and employer allocation eligibility. Is that still a thing going on?
Yes, unfortunately, I think depending on the firm's size, very prevalent, especially the larger you get, the more that's the case. There's like this very multi-stage review process where when it gets out the door at, a good portion of firms, the quality's there. It's like making sausage. We've got a little bit of a nuanced approach where we have someone with, kind of minimum 7 to 10 years of EVP experience. That's the primary point of contact. And then we do have a pod lead that's, 10 to 15 plus years. And then we still have those associates and data entry specialists, but you're shielded from them. They're kind of on the back end, and then they graduate after 3 to 5 years.
I'm talking about they just got their shingle last week. All right. And now they're the only contact we have for the large plan audit. And, we're TPAs are going to bill for the training, but it's a little annoying when they're getting billed out at a larger amount per hour than we are, and we're doing the training. So,
yes. And then maybe some finger pointing. I don't, that's not us, but I'm just saying a lot of times they're like, well, we had to do X, Y, Z. And then, kind of the partner gets involved to reinforce why the bill that the firm sent is applicable. So that is very much common, because I think at larger firms, and just in general, it could be any firm really, but what happens too is they tend to be lower margin engagements. So who gets assigned to lower margin engagements is lighter experienced individuals a lot of times. So a lot of firms have been trying to get away from that, moving towards a fixed fee. Some are still hourly. So obviously it's going to take, an intern or a first year a lot more time, even if their billing rate's a little bit less. But a lot of times it just is, can be a challenge. I've actually even was on a phone call with Brian Graff, and it was a very interesting. He's basically like, you can improve, I think as a profession, it needs to improve because it is stressful and pull down on both the plan sponsor side. It's also a big pull down on the provider side. So really outside of a regulatory requirement, nobody's looking to do this thing. Even if it is a smooth process, a lot of times it's not. And it tends to be more complex, more onerous each year. And I think definitely, needs to move to an efficient mid-ground. Also, the downside of being self-regulated, 100 different firms will approach it 100 different ways. And so they're giving you, kind of PBC request lists that are all over the board. This one only wants PDFs. This one only wants CSVs. This one wants, a little bit of blend of this and that. And all are looking at a little bit different process and approach. But that is interesting and nuanced and still affects.
Great. Okay. All right. So I think I've got one more closing question. Well, or maybe, I don't know if it's two closing questions or one. Okay. So one, is there something about your industry that nobody ever asks you that you wish did? Okay. And then number two, what changes are you pontificating, expecting, hoping, dreading in your industry? Maybe not, I'm not talking about your firm or you, but for your side of the table. I think that is two separate questions. Sorry.
Yes, great question. I would say question. Someone would ask me that never gets asked. I think we touched on it on kind of some of the licensing type of issues as well too. Because even through the due diligence process, it kind of comes up a lot that I'm a little bit surprised how few people check on if a CPA is actually licensed, if they're licensed in
QKA. Holy crap. I'm like, sorry, it completely, all the pennies just dropped. Holy crap. I'm like, why is it a big deal? He's a QKA. We come across QKAs all the time. Oh, he's a CPA.
Yeah.
He's excited he was a CPA with a QKA.
Yeah, but you only have, you got Travis on there as QKA, not Travis CPA QKA.
Yes, there we go.
Or I can't read. I'm dyslexic. Whatever.
Yeah.
I'm not reading all the notes, obviously.
Yeah, individually, that would be a great question to receive in the RFP process, because it is a very much more detailed course related to administration, and I think speaks to volumes to your experience as well too. Auditors typically are broad strokes in extracting and analyzing data. It's less of a deep understanding than actually doing the administration or being involved. It's one thing to look at an ACP test, ADP ACP testing. It's another thing to actually take a census and do it. And then you understand what could go wrong, what could go sideways. What do you actually receive from the client? It's just a very different and I think good lens to start with as well.
Okay, and then so changes?
So changes, I would say, I don't know if we're doing our best, and I think in a pretty good spot to get ahead of rapid tech changes. So I think trying to be shortly behind, some of the big four. And I think there is kind of a big pinch in the middle as well too. And especially, small firms that aren't getting ahead of the tech curve, where I think regulatory changes combined with technology changes will put a lot of the small folks out of business or in a place where they have to merge or, kind of get forced into a buyout type of situation if they don't react fast enough. So have a great development team. We have a super fantastic IT director with a dev background. So very much working to get ahead of that. We actually have reserved pepaudit.ai, mapaudit.ai, and kind of some other sites to be the front end face and automate a lot of those inner activities.
We have some domain names we might consider selling you that we've been sitting on.
That's it. Nice. I'll scoop them up.
Wow.
But yeah, so those are kind of in a nutshell.
So what's interesting, though, about roll-ups and buyouts and industries and how they affect both of our industries since you have to be a licensed CPA to buy a licensed CPA firm, you guys are selling within the industry more than in our industry. We're getting rolled up by VC firms, right? That's correct, right?
Yes. Well, primarily, and great point, we're getting a huge spike up in PE interest to retain a portion of ownership, usually contractually working to get a control type situation at the firm level. And ironically, a lot of accountants in the industry in general tends to be slow to adopt to change and pretty introverted folks on the technical side. Standard, I think we make actuaries look like rock stars for the most part. No, I think you just have this huge opportunity.
Yeah.
Where if you pick up the phone or respond to an email or don't make people feel awkward in a conversation that goes more than a minute, that puts you in the top like 5%.
Yeah.
So I think PE's really seen that recurring revenue model and how inefficient it is, and are like, hey, I kind of want to in on that. It's not could be a lot better. So it is interesting to see the models evolving rapidly.
So for private equity to buy a firm, do you have to have like 51% ownership of a CPA or something, or how does that actually work? I just thought it wasn't even.
Most states, yes, but it really does depend, and I think the rules are shifting. Even the 150-hour requirements kind of going away, and I think things have been evolving where some of those doors may be more open, or I think one of the big four just popped open a law firm here in Arizona where that specifically used to be, very different sides of the house, and there were kind of some licensing complications there. So I think some of those barriers are being removed, but I wouldn't see percent ownership changing in the very near future for most states.
In Illinois, the professional entities like doctors, lawyers, accountants, the last time I looked, I don't think it's changed. They have to have 51% has to belong to the professionals, and 49% can belong to anybody else.
Okay.
Yep.
And that could be the P, but PE does
still currently
like 49%. Yeah. They want 50.01.
Yes.
At least.
Wow.
So, wow. Okay.
Well, as usual, we learn things by doing
this is really great.
Christopher actually took notes. Do you know what I mean? He wasn't reviewing his questions. He was taking notes. So he's glad.
I know I have to watch. I don't have to. I get to watch the video again later. But it is good to take the notes now. It is always very enlightening. You've been a great guest. Thank you so much for doing this. The next time we're in Phoenix, there will be one more time this year. We will definitely come by and say hello, unless you're back on the homestead. So, but thank you so much for doing this. This has been fantastic. And
likewise, could appreciate you more.
So, definitely easy to find you on LinkedIn, and then, and we'll probably have something in the show notes.
There'll be something in the show. Yeah.
So Christopher, so people need to like, subscribe.
Tell friends and neighbors, tell people they don't like, just tell somebody about it. And like I say on the YouTubes, don't forget to keep those cards and letters coming.